Tens of billions of dollars in signed deals. Microsoft, Nvidia, CoreWeave, and a company quietly running clusters for Anthropic. And the businesses cashing those checks. They aren't the AI names you know, they're old Bitcoin miners. Here's the part nobody told you. The AI boom doesn't have a chip shortage anymore. It has a power shortage. Every new model needs a building full of GPUs, and that building needs gigawatts of electricity already plugged into the grid, ready to run today. Guess who spent the last few years grabbing exactly that kind of power to mine crypto? Gustav Rusarv. So now there's a role reversal happening in plain sight. 5 former Bitcoin miners are turning into something completely different. AI landlords. They own the power, they own the buildings, and they're signing 10, 15, even 25-year leases with the biggest names in computing. We're talking tens of billions in contracted revenue. And here's the kicker. Not one of these 5 is in the S&P 500. So while everyone fights over the same handful of mega-cap AI stocks, this whole pivot is happening one rung down the ladder, where most people aren't even looking. By the end of this video, I'm ranking all 5 from the best risk-adjusted bet to the one that's still mostly a Bitcoin miner wearing an AI costume. The order might surprise you. Quick note before we go further, because it matters. I'm Sarah, and this channel is about helping you understand money, not telling you what to buy. So everything here is education, not financial advice. These are some of the most volatile stocks on the market, so please do your own research and talk to a professional before you put a single dollar anywhere. Cool? Cool. Let's get into it. Before I name names, let me give you the one filter that separates a real AI data center business from hype, because you're going to want it. 3 things. 1. Power that's already connected to the grid and ready to energize, not a press release about land they might build on someday. Power is the bottleneck, so this is the whole game. 2. Signed long-term leases with a real named tenant, not a friendly handshake and a wink. And 3. Actual AI revenue showing up on the income statement right now, not a promise of revenue in 2028. Real megawatts, real contracts, real billing. Keep those 3 in your head, because the gap between who has all 3 and who has a slide deck is the entire story. A Bitcoin miner can rent a few GPUs and call itself an AI company. A real AI landlord is energizing buildings and mailing invoices to Microsoft. Same costume, completely different business underneath. By the end, you'll be able to tell which is which on site. And one more honest note. Every single company on this list posted a net loss last quarter. Sounds scary, but most of those losses are non-cash. Things like Bitcoin and warrant markdowns on paper, not the business bleeding out. I'll flag it each time so you know what's real. We're going biggest to smallest by market cap. Let's start at the top. Stock 1 of 5 is IREN, ticker IREN, formerly Iris Energy. And honestly, this is the one that already works. Market cap around $19.6 billion, trading near $54.72 a share, which makes it the giant of the group. It's run by co-founder and co-CEO Daniel Roberts, who leads it alongside his brother Will. And Daniel put the whole thesis in one sentence. He said the world is structurally short compute, and the bottleneck is delivered data center and GPU capacity. Translation, everyone wants AI horsepower and almost nobody can plug it in fast enough. He's selling the plug. Now the numbers, because this is where IREN separates from the pack. Trailing 12-month revenue of $757 million. Their AI cloud revenue nearly doubled quarter over quarter, up 94%. They did post a net loss of $248 million, but that's mostly non-cash mining write-downs. And underneath it, the adjusted earnings came in positive at $59.5 million with a 41% margin. That's a real margin on a real product. They're sitting on about $2.6 billion in cash against roughly $3.7 billion in convertible debt. And the signed deals are blue chip. Microsoft, $9.7 billion over 5 years. Nvidia, $3.4 billion over 5 years. They're targeting around $3.7 billion of annual recurring revenue by the end of 2026. So why is the risk still very high? Because all of that debt is funding the build-out, and the whole story rides on a flawless construction sprint at their Childress site, scaling towards 750 megawatts by the end of this year, on top of a pipeline that stretches toward 5 gigawatts. That is a staggering amount of power to bring online on schedule. If the GPUs slip, or the financing tightens, the math gets uncomfortable fast. This is not a sleepy dividend stock, it's a high-wire act with a real net underneath it. As for the targets, and these all come from stock analysis as of June 2026, so we're using one source the whole way. Bear case $41, base case $80.93, bull case $126. From today's 54 and change, the base case alone is roughly 48% upside, and the analysts rate it a buy. It gets us off to a strong start, but the next one is bigger and more billion-dollar than its actual revenue. Stock 2 of 5 is WULF, TeraWulf, market cap around $14.3 billion, trading near $28.78. And the CEO, Paul Prager, who co-founded it and has run it since 2021, says something I actually love. He says TeraWulf is fundamentally a power infrastructure company that builds digital infrastructure, not the other way around. Power first, computers second. That's the whole pivot in one line. Here's where it gets interesting and a little nerve-wracking. The backlog is enormous and the live business is tiny. Last quarter, they did $34 million in revenue, basically flat year over year, split between an HPC lease and what's left of mining. The net loss was a giant $427.6 million, but, and this is important, most of that was a non-cash warrant revaluation, $216 million of pure paper. Cash is strong at around $2.6 billion. Debt sits near $3.6 billion. Now the deals. Fluidstack, which is backed by Google, signed for 200 plus megawatts over 10 years worth about $3.7 billion, with Google backstopping roughly $1.8 billion of it. Then a Texas joint venture, 168 megawatts over 25 years, worth about $9.5 billion. Add it up and you're looking at around $13 billion in Google backstopped contracts. So what's the catch? Only 60 megawatts is actually energized and billing right now. 60. Against all those billions. Most of this story is future dated, which is exactly why the risk is very high. The targets from stock analysis: bear 27, base $36.34, bull $66.50 against today's $28.78. That base case is about 26% upside, and it's rated a strong buy. Great contracts. Thin live revenue. File that away because our next company has the opposite problem in the best way. Stock 3 of 5 is HUT 8. Market cap around $13.6 billion, trading at $120.51, the highest share price of the group. CEO Asher Ganut has run it since early 2024, and his line tells you the playbook. He said Beacon Point underscores why we start with power and maintain flexibility across end markets. Start with the electricity, stay flexible about who you sell it to. Smart. By the way, real quick, before we keep going, if you're getting value out of this, do me one favor and hit that subscribe button. We break down stocks and money stories exactly like this one every single day, totally free, and it genuinely helps the channel grow. That's it. Back to HUT 8. So HUT 8 brought the biggest contracted dollar figure on the entire list. Revenue last quarter was $71 million, up 226% year over year, with the compute side doing $66 million of that. Trailing 12-month revenue around $284 million, with gross margins near 64%, which is genuinely fat. Yes, there is a net loss of $253 million, but again, almost all of it, nearly $296 million, is a non-cash Bitcoin markdown. Cash and Bitcoin together sit around $1.3 billion, with debt near $3.25 billion. And the headline number is wild: 597 megawatts of contracted AI capacity and $16.8 billion in aggregate take-or-pay contract value. The signed deals: Beacon Point in Texas, 352 megawatts over 15 years, $9.8 billion, and Riverbend in Louisiana, 245 megawatts over 15 years, $7 billion, with a tenant called Fluidstack running clusters for Anthropic, backstopped by Google. Now the honest part, because I promised you honest. The marquee Beacon Point tenant is undisclosed, just described as investment grade, and that mystery is part of the very high risk along with the Bitcoin-driven losses and a stock that has swung from $15 to $141 in a year. The stock analysis targets: bear 70, base 119, bull 156, against today's 120.50. And I won't sugarcoat this one. The base case is basically right where it trades today. It's rated a strong buy, but the market has already priced in the good news. Hold that thought, because the next two companies are both selling a future that hasn't arrived yet, just at very different speeds. Stock 4 of 5 is APLD, Applied Digital. Market cap around $12.9 billion, near $45.27 a share. Chairman and CEO Wes Cummins, who co-founded it, basically described the gold rush. He said they're seeing a clear acceleration in demand for high-performance AI data center capacity, with hyperscalers as aggressive as he's ever seen them. When the buyers are desperate, the landlord wins, and they are growing fast. Last quarter, revenue of $126.6 million, up 139% year-over-year. Trailing 12-month revenue of $319 million. The net loss was $100.9 million, but the adjusted earnings were positive at $44 million, and they actually posted adjusted net income of $33 million. Cash of $1.73 billion against debt around $2.7 billion. The big deal here is CoreWeave. 2 leases, roughly 15 years each, anchored at their Ellendale, North Dakota campus, and combined they're worth about $11 billion in expected revenue. That's the largest single-tenant backlog on this list. They've also broken ground on a new 430 megawatt site. But here's the part that keeps me up at night with this one. CoreWeave basically is the backlog. One customer, $11 billion in expectations, plus that $2.7 billion in debt. And the company's still unprofitable on a GAAP basis. If CoreWeave so much as sneezes, the whole thesis catches a cold. That's the very high risk in a sentence. The targets from stock analysis bear 40, base $73.36, bull 106 against today's 45 and change. That base case is the biggest upside on the whole list, about 62%, and it's the only name here rated a strong buy with that kind of room to run. Real leases, real growth. One giant question mark, named CoreWeave. Which brings us to the last one, and the one furthest from finishing its costume change. Stock 5 of 5 is RIOT, Riot Platforms, the old Riot blockchain. Market cap around $10.85 billion, near $28.68. CEO Jason Les has run it since 2021 and just survived an activist campaign from Starboard Value earlier this year. His quote is refreshingly blunt. He said Bitcoin mining is a tool to bring power capacity forward, and now they're using it to unlock infrastructure for AI and HPC. The mining built the on-ramp. Now they want to merge onto the AI highway. And the funny thing is, Riot has the highest revenue of all 5. Last quarter, $167.2 million, up about 3.5% year-over-year. Trailing 12 months of $653 million, the most of the group. So you might be wondering, if it makes the most money and carries the least debt, how on earth is it ranked last? Stick with me, because this is the perfect example of why the headline number can lie to you. They've got a fortress-like balance sheet too, $282 million in cash, plus around 15,679 Bitcoin worth roughly $1.1 billion, and the lowest debt of the 5 at about $594 million. So why is it last? Because of where that revenue comes from. Last quarter, about 2/3 of it, roughly 67%, was still plain old Bitcoin mining. Only about 20% was the data center business. Their big Corsicana, Texas site is a full gigawatt of approved power, but 400 megawatts of it is currently mining coins, and the expansion to chase AI is paused while they figure it out. The one signed AI tenant they've got is AMD, starting at 25 megawatts, scaling to 50, with the real payoff not landing until around 2028. There is a $500 million net loss too, though. You guessed it, most of it is a non-cash Bitcoin markdown. Very high risk, and the pivot is the least proven here. The stock analysis targets bear 20, base $28.55, bull 45 against today's 28.68. So, just like a couple of the others here, it's trading right at its base case. Rated a strong buy, but the market is paying for what it sees today, not the AI dream. Okay, you sat through all 5. Here's the ranking I promised. Best risk-adjusted bet first. Number 1 is IREN. It's the only one on this list actually invoicing AI cloud revenue at real scale. It's got Microsoft and Nvidia signed, a genuine 41% adjusted margin, and $2.6 billion in cash. It has the cleanest path from hype to actual billing. That's the win. Number 2 is Applied Digital. The biggest single-tenant backlog at around $11 billion on real 15-year leases. It's adjusted profitable, and the upside to base case is the fattest on the list. The only knock is that everything rides on CoreWeave staying healthy. Number 3 is Hut 8. The biggest contracted dollar figure anywhere here, $16.8 billion, with a true power-first platform. It drops to third only because its marquee tenant is undisclosed and the stock already prices in the base case. Number 4 is TeraWulf. Those Google-backstopped Fluidstack deals are fantastic, around 13 billion combined, but only 60 megawatts is live and revenue is flat. Beautiful future, barely there present. And number 5 is Riot. Highest revenue, lowest debt, real assets, but it's still about 2/3 a Bitcoin miner. Its only AI lease is small, and the real payoff is years out in 2028. The least proven pivot, even with the most drama. So here's the honest through line, tying all 5 together. When you buy any of these, you are not buying a finished AI business. You're buying the promise of a pivot. The edge, the real edge, goes to whoever turns signed megawatts into build compute first. Contracts are easy to announce. A press release costs nothing. Energizing a building and actually invoicing a hyperscaler month after month is the hard part. And that's the part that pays. Right now, IREN is winning that race, and Riot is still tying its shoes. Everyone else is somewhere in between, sprinting hard. And that's why these can swing so violently, because the market is constantly re-guessing who's going to cross the finish line and how fast. The ones that turn their backlog into real billing get rewarded. The ones that stall get punished. It really is that simple and that brutal. If this helped you see these 5 a little more clearly, the best thing you can do is hit subscribe. We do exactly this, plain English money breakdowns every single day, and I'd love to have you back tomorrow. Until then, keep asking the smart question, not who announced the biggest deal, but who's actually getting paid. That's the one that tells you who's real. Take care of yourselves, and I'll see you in the next one.